Hi, welcome back to Cheryll Trades Leaps. Most retail traders do not sell because the chart is broken. They sell because they are tired. Tired of waiting. Tired of sideways price action. Tired of bad headlines. Tired of watching their options lose value every single day. Tired of seeing other stocks move while their position does nothing. And a lot of the time, that emotional exhaustion happens right before the real move begins. If you have ever sold a position out of pure frustration and watched it run without you, this video is for you. Today, we are going beyond the chart. We are not just looking at RSI, MACD, moving averages, or support and resistance. We are looking at something deeper. The sentiment cycle. Because sometimes the best reversal signals do not start with a beautiful chart. They start when retail traders finally give up. And that is often when smart money starts paying attention. I want to be clear before we go further. This is not about knowing exactly where institutions are buying. Nobody can know that perfectly. This is about learning to identify the zones where retail fear becomes extreme, where price stops breaking down, and where accumulation may be starting quietly underneath the surface. That is where opportunity begins. Not when everyone is excited. Not when social media is full of bullish price targets. Not when the stock is already running. But when people are bored, frustrated, fearful, and ready to quit. That is the emotional imbalance we are going to study today. Because in the market, the crowd often gives up at the worst possible time, and patient traders can use that against the crowd. Let's get into it. Part 1. Why retail traders give up too early. Retail traders love momentum. They love stocks that are moving fast. Green candles. Exciting headlines. The feeling that something big is happening right now. But the market does not usually reward impatience. Many of the biggest moves begin after a long period of frustration. Here is the pattern. A stock runs up, gets a lot of attention, pulls back, and then enters a boring sideways range. At first, retail stays confident. This is just consolidation, they say. Then the stock does nothing for days. Then weeks. Maybe months. Price goes sideways. Headlines are mixed. The chart looks weak. The options are losing value. The excitement disappears. And slowly, confidence turns into doubt. Doubt turns into frustration. Frustration turns into fear. Fear turns into surrender. That is retail exhaustion. It is not always a dramatic crash. Sometimes it is just a slow emotional breakdown. The stock does not have to collapse 30% in one day. Sometimes all it has to do is go nowhere long enough for people to lose patience. This matters even more for leaps traders. With long-term options, time is always working against you. Even with an expiration far out, you still feel the pressure. You see the position down 5, 10, 20%. You start wondering if you bought too early. You wonder if the stock is dead money. You wonder if another stock would have been better. That right there is exactly when most traders exit emotionally instead of strategically. This is the patience test. And most people fail it right before it would have paid off. Smart money does not think like that. Institutions are not trying to feel excited. They are trying to build positions. And big positions cannot always be built during obvious breakouts. If a large buyer wants to accumulate shares, they usually do not want to chase price higher. They want liquidity. They want sellers. They want fear. They want frustration. They want retail traders to hand them shares. That is why emotional exhaustion matters. When retail is tired of holding, someone else may be quietly willing to buy. Part 2. The 3 sentiment phases. There are 3 sentiment phases that tend to show up before a reversal. Phase 1 is euphoria. Everyone wants the stock. The chart is strong. The news is positive. Analysts are raising price targets. Social media is excited. People are talking about life-changing gains. This is when retail feels the most confident. Ironically, this is also when risk is rising, because when everyone is already bullish, a lot of the buying has probably already happened. The stock may still go higher, but the easy money is usually gone. Late buyers often become liquidity for earlier buyers. Phase 2 is boredom. This is the phase most traders underestimate. The excitement fades and the stock stops moving. It trades sideways. The candles shrink. Volume dries up. Price does not collapse, but it does not reward you either. This is where patience gets tested. The market is basically asking you, do you really believe in this trade, or were you only here for fast money? Boredom is dangerous because it does not feel dramatic. But emotionally, it can wear a trader down more than a sharp pullback. At least during a pullback, there is action. During boredom, there is nothing. No confirmation, no excitement, no reward. Just waiting. And most retail traders hate waiting. Phase 3 is capitulation. This is when traders finally give up. Sometimes it happens fast, after a sharp drop or bad news or a broken support level. But sometimes capitulation is quiet. People lose interest. Nobody talks about the stock anymore. The bullish comments disappear. The same traders who loved the stock at higher prices now call it dead. People sell, not because the long-term story changed, but because their emotions changed. Here is the important part. When sentiment becomes extremely negative, but the price stops going lower, that is a powerful clue. It means fear is high, but sellers may be losing control. That is the zone we want to study. Not blindly buy. Study. Part 3. What accumulation may look like. We cannot see every institutional order, but we can look for clues. Clue 1 is price stability during bad sentiment. If the news is negative, social media is bearish, retail is frustrated, but the stock refuses to break lower. Ask yourself why. If everyone is scared, why is price holding? That does not guarantee a reversal, but it tells you supply and demand may be shifting. Clue 2 is lower selling pressure. Maybe the stock keeps testing the same support area, but each drop gets weaker. First drop heavy, second drop less aggressive, third drop barely pushes below the prior low. That can show sellers are getting exhausted. Clue 3 is volume behavior. During real accumulation, volume may increase near support while price does not collapse. That can mean shares are changing hands. Weak holders selling, stronger buyers absorbing supply. Clue 4 is failed breakdowns. A stock breaks below a key level, triggers fear, then quickly reclaims that level. This is where a lot of retail stop losses get triggered. People panic, they sell, then the stock moves back up. That is a classic liquidity grab, shaking out weak hands. For leaps traders, this matters a lot. You do not want to buy every dip. You do not want to average down just because a stock got cheaper. You want to see whether the stock is stabilizing, whether fear is no longer pushing price lower. That is the difference between catching a falling knife and buying near a real reversal zone. Part 4. The Contrarian Signal. Fear alone is not enough. A stock can be hated and keep falling. A stock can be cheap and get cheaper. Negative sentiment by itself does not make something a good trade. So we need a checklist. Question 1. Has retail sentiment become clearly negative? Are bullish comments disappearing? Are people calling it dead money? Question 2. Is price becoming stable? We do not want fear plus a collapsing chart. We want fear plus stabilization. No more aggressive new lows. Support starting to hold. Question 3. Is volume showing support? Look for signs that selling pressure is being absorbed. Question 4. Did the stock reclaim a key level after a breakdown? This is one of my favorite reversal clues. Breaks support, scares everyone, triggers stops, then quickly moves back above that level. That can show the breakdown was a trap. Question 5. Is the risk to reward attractive? A contrarian setup does not mean going all in. It means planning carefully. Where is your invalidation level? Where are you wrong? How much are you willing to lose? For leaps, I do not buy just because a stock is down. I want the setup to give me a reason. Fear plus price stability. Fear plus absorption. Fear plus a reclaimed level. Fear plus improving structure. That is when fear starts becoming useful, not as a reason to panic, but as a signal to prepare. This is basically my Vegas check applied to sentiment. If the only reason you want in is because it feels cheap or you are bored watching it sit there, that is not a reason. That is a tell. Part 5. The sentiment to volume ratio. Here is a simple way to think about it. You are comparing emotion against real buying and selling activity. High fear plus weak price equals caution. High fear plus stable price equals watch list. High fear plus strong volume support equals possible accumulation. High fear plus reclaimed support equals possible reversal setup. This keeps you from blindly buying every hated stock, because not every hated stock is a bargain. Some are hated for a reason. The goal is not to be contrarian just to be contrarian. The goal is to find the moments where the crowd is emotional, but price action is no longer confirming their fear. Sentiment falling, price stops falling. That divergence is what we pay attention to. Part 6. How to trade it with leaps. Finding the setup is only half the job. Executing it is the real challenge. Rule 1. Start small. When sentiment is negative, the chart may still look ugly. You do not need full size right away. A starter position lets you participate without overcommitting. This matters even more with leaps. Time works in your favor long term, but price can still move sharply against you short term. Rule 2. Wait for structure. Stop making lower lows. Support holding. A reclaim. Improving volume. The stock acting better even while sentiment is still negative. Rule 3. Respect earnings. A sentiment reversal setup can still fail through an earnings print. Guidance, margins, growth, AI spend, macro comments, all of it can reset the chart overnight. I do not blindly hold short-term calls through earnings. For leaps, I am still careful. Sometimes I trim before earnings. Sometimes I wait until after to enter. Sometimes I keep only a small position if conviction is high. I don't trade the news, I trade the reaction, and earnings is exactly where that discipline gets tested. Rule 4. Define your invalidation before you enter. A break below support. A failed reclaim. Volume disappearing. Sentiment staying negative while price makes new lows again. Whatever it is, define it before the trade, because if you do not define your risk before entering, your emotions will define it later. And emotions are expensive. Rule 5. Scale only when the market confirms you. This is the biggest difference between patient trading and emotional trading. You do not need your full position at the bottom. Small starter when the setup begins. Add when price reclaims a level. Add again when trend improves. Hold the stronger position once the reversal is more obvious. Your average price may end up higher, but your probability is usually better too. We are not trying to win every penny. We are trying to make good decisions over and over again. Part 7. A practical example. Picture a stock that was very popular a few months ago. Everyone loved it. Strong chart, excited retail crowd. Then it pulls back. At first, people call it a dip. Then it goes sideways for weeks. The comments change. This stock is dead. I should have sold earlier. This is going nowhere. I am tired of waiting. I am moving my money somewhere else. That is boredom turning into frustration. Then the stock breaks support for one day. Retail panics. Stops trigger. People sell. But instead of collapsing, the stock quickly reclaims that support level. Volume increases. Price holds. The next pullback is weaker. Higher lows start forming. At that moment, the chart may still not look exciting to most people. But something has changed. Fear is high, retail confidence is low, but price is no longer confirming the fear. That is the setup. Not a guarantee. A setup. This is when a patient trader starts watching closely. Maybe a small starter position. Maybe waiting for the reclaim to hold. Maybe waiting for a crossback above the 20-day or 50-day moving average. Maybe waiting until after earnings. Your exact entry depends on your own A+ setup checklist. But the idea stays the same. You stop chasing euphoria and start studying exhaustion. That is a much better place to look for opportunity. Part 8. What this means for smart money. Smart money does not need to buy when everyone is excited. Excitement can actually be expensive. When everyone is bullish, prices are higher, liquidity is crowded, expectations are elevated. When retail is exhausted, the environment changes. More sellers, lower expectations. Price already reflecting a lot of fear. That gives larger players a better opportunity to accumulate. This is why some reversals feel confusing at first. The stock starts rising even though the news is not perfect. Analysts are still cautious. Social media is still negative. Retail is still skeptical. That is exactly why the move can continue, because the crowd is not positioned for it yet. When the stock recovers, traders get forced to chase back in. Short sellers cover. Former bulls re-enter. Momentum traders notice the breakout. The stock nobody wanted becomes the stock everyone wants again. By then, the best entry is usually already gone. We study sentiment early, not to predict perfectly, but to prepare before the crowd changes its mind. Part 9. Common mistakes to avoid. Mistake 1. Buying only because sentiment is negative. A hated stock is not automatically a good stock. Sometimes sentiment is negative because the business has real problems. Weak earnings, bad guidance, slowing growth, too much debt, no clear catalyst. Separate emotional fear from real business weakness. Mistake 2. Going too big too early. Even a good setup can retest lows, shake out traders more than once, or move sideways longer than expected. Position sizing matters. Mistake 3. Ignoring macro. In a volatile market, even good setups can fail if the broader market is under pressure. Rates, inflation, Fed policy, jobs data, oil, geopolitical risk. Do not study one stock in isolation. Mistake 4. Confusing hope with a setup. Sometimes we call sentiment too negative because we already own the stock and want to feel better about it. That is not analysis, that is hope. A real setup needs evidence. Price stabilization, volume support, reclaimed levels, improving structure, clear risk management. Without those, it is just wishful thinking. The market is not just numbers. It is emotion. Fear, greed, boredom, frustration, regret, impatience. And a lot of the biggest opportunities appear when emotion becomes extreme. Retail traders often buy when they feel confident and sell when they feel exhausted. Smart money often does the opposite. It waits for forced selling. It waits for boredom. It waits for panic. It waits for weak hands to exit. Then it builds positions while the crowd is still emotionally damaged. A chart shows you price. Sentiment shows you pressure. When fear is high but price stops falling, pay attention. When retail gives up but volume starts supporting the stock, pay attention. When a breakdown fails and support gets reclaimed, pay attention. That does not mean buy blindly. It means prepare. Build your watch list. Wait for confirmation. Start small. Respect earnings. Protect your capital. We are not trying to catch every bottom. We are not trying to win every trade. We are trying to make good decisions over and over again. So the next time a stock looks boring, hated, and forgotten, do not ignore it too quickly. Ask yourself, is this truly broken, or is this retail exhaustion before the next reversal? That question alone can change the way you trade. It can help you stop being part of the liquidity and start thinking more like the patient money. If this framework made sense to you, hit subscribe, because every week I break down how I actually use leaps to trade these setups instead of just talking theory. Drop a comment and tell me the last stock you gave up on right before it turned around. I want to hear it. See you in the next one.